today I'm really excited to have Sharad Bansal back on Insider's Talk. So I remember that we spoke a couple of years back for Tinkerly, right, with you,
Yeah.
and it was really amazing. And now you are with Warm Up Ventures. So how did your journey come up? Like in the sense that you started with Tinkerly, it's a edtech company, it's based out of STEM education. So from there to Warm Up Ventures, how has that transition been for you?
Yeah, I think first of all, thank you so much, Veronica, for having me again on the show. Uh, I think the journey has been pretty organic. When I started Ingerly, I think in those times I was not even familiar with what entrepreneurship is. But then learning about entrepreneurship, investing happened along that journey. How I mean, during my 8 years at Tinkerly, I was mostly on the other side of the table, raising capital for the company and allocating that and planning that and doing strategic business development. I think I would have spoken to 100 plus investors, VCs, angel networks, etc., and I've seen that what a founder seeks at that kind of an early stage investing from an investor, and what are the acts and what are the roles of investors make them differentiate from others. So has been learning that hands on. Then I think 2019 onwards, I started writing early angel checks into startups. So
Okay.
me and one of my friend Rajan, who runs in another agri-tech venture, we have been together discussing a lot of times. Okay, we are writing a small check in this company. Sometimes we are doing together, sometimes doing separately, and both of us have been almost similar timelines of running our own ventures. So we realized that okay, we are doing that, but there are a lot of similar friends like us who wants to invest in early stages, but in silos you're not able to find the right companies, you're not able to get the right deals, or also you're not able to play a significant role in the founder's journey, because you are all small checks. So we thought of bringing all such founder folks together and create a VC which is flavored like an angel. So I think that is the idea of warm up, and as the name says, we invest early. This is like the first investing, warming up while you before you get onto your marathon. So that's how the transition happened.
Mhm. And do you think that, because you have bought in like basically founders, right? They have all gone through this kind of a journey and they understand the kind of, anxiousness, anxiety, the kind of passion a founder can get when they pitch the idea to the ventures. So do you think that this is also one of the edge where they might feel a little bit more comfortable because they know that all of you are founders and you probably understand, where they are coming from?
Absolutely, I think that's a bang on. So that's the one of the key USPs that we present. So founders feel very comfortable speaking to us. Not only just comfort about talking, but also about sharing things that they might be hesitant about sharing with a VC, like things
Right.
which are not working for them, why they are not working for them, what kind of failures they have seen. So they know that okay, we would have also been in that journey. We have been in their shoes, so they are more open and comfortable about sharing those things. So I think, and that's not only about before raising the capital. I think our proposition to founders has been that when we associate with you, we will be on your side of the table even in board meetings. So I think that that is something very critical, as I was mentioning earlier. What differentiate an early stage investor from the rest of the other investors is that how you act and how you treat the founders. So I think you are absolutely on point when you're saying about the comfort of the founders speaking to investors.
Really, that's really good because investors come from a different mindset, right? I mean, and you are coming from a different mindset. Reason being, you have yourself churned out that journey. And during the pitches or whatever pitches you receive in terms of the requests, or when they personally come to you and they pitch the idea, has it been that you have also actually told them, you go back, you work on these points and then come back to us and we will discuss it. You have a fabulous idea, but this is the where these are the places where you need to really work on, and then you come back and we'll see what we can do.
Happens. I mean, often it happens. Like, I mean, what I relate to a lot of founders is that sometimes they wouldn't know why they're raising. Uh, Sometimes they wouldn't know how much they should raise depending on their stage of the company. Sometimes they feel like, okay, they want to raise X amount. Let's say I want to raise $1 million at 5 million valuation. So they want to that they aspire to raise 1 million and they know what they want to do with 1 million, but they're not doing the reverse maths or they're not doing the future math that, okay, to raise the next round of 5 million, would they be able to reach at a 20 million valuation? So how much they have to achieve to reach that point and how much aggressive path they're choosing for. So sometimes asking the right questions with the founders help them to identify that, okay, what I'm asking for, what I'm signing up for. So sharing those insights. So I think that way founders see a lot of visibility. So we are very candid with founders that, okay, you might be raising this much at this point of time. Maybe you should raise slightly higher because you would want a higher runway, or maybe you should raise slightly lesser so that you have lesser burden of going fast in the near future, so that you develop and reach to your technology or product to the stage, then you will raise much more amount. So it depends on that stage. We have been in that journey, we have seen that where we have done mistakes. So and our suggestions founders are able to take constructively also, because they also relate that, okay, this guy is not only talking about I mean, that's what they think. And we just say that, okay, this is what we feel, this is suggestive, not at all enforced. They are the best person, they are the executioner. We know where our limit is. We can only be suggestive in our approach. But it's the founder who which makes difference in a company's success or failure. So they are the main player. We can just be from the outside. So a lot of time it happens. A lot of times we feel like from the warm-up thesis, this may not be the right stage of investing. Either it is too early or it is too late to invest. But we feel the founder is great, the business is great. And in several scenarios, like we would have done about 10 investments, but more than 25 odd companies, we would have helped in connecting with other investors, actually helping them to raise that round, connecting them with some potential clients who can give them early feedbacks and also could become a potential angel investors. So we feel like, I mean, our role is not about only investing and helping those companies. Our role is to play a critical our job is to play that critical role in any good founder's journey, whether we formally associate as an investor or just help them out of our network. So I think we want to play that enabler's role in the early stages of this ecosystem.
That's really interesting, because it's not just about, when you hear about warm up ventures, I truly thought, so this is a big bubble bursted for me, at least, that it is not just about investing and finding good ideas where you can really work with them and create something out of it which is valuable, but it is also about guiding them and mentoring them to reach at a stage where it is rightfully pitch the kind of evaluation that they need. And another thing that you mentioned right now was, some people they really want things to happen too fast and they're very aggressive. So these are two key things I've seen where, many good startup ideas have failed. Reason being that they raise the money that they actually need for execution, but the right way of using that money to get to that phase is where they really struggle, because they think that probably big scale employment is hiring is going to help them reach what they thought would be 3 years can be achieved in a year. I don't know what goes in the mindset, but fabulous ideas have failed just because the execution part has been really bad even after acquiring the money that they needed.
Yeah, I think a lot of time that happens is that when you are not incorporating the potential market risks or execution risks, like VCs are in the business of making money, and they would say, okay, if they find a really good team and find someone solving their problem, which is very large enough, they think they can value the company at whatever price they think, because if this be successful, this will become large enough to make them returns. But the founders also have to think that, okay, what business they are in. They are not primarily just doing it to make money for VCs, but they are also trying to solve a problem. So they should see that what pace is the right for the company and what could be the all potential risks. Now, when you decide, let's say I want to raise 1 million, and it has happened in several of our companies scenario. Let's say you want to raise 1 million and you got commitments of about $2 million. Now the problem is that you sometime might be attracted that, okay, take this capital, and maybe there is the new investor would also increase the valuation that, okay, you're getting at 5 million, I'll give you at 8 million. So you'll dilute same equity for the double of the amount. So it would be obviously financially a better offer to take up. But now you have to imagine that, okay, if I am coming at this value and this investor is coming at this value, after 1 year or 2 years, I would need next round of capital, and I have to go significantly up. Now, to achieve that benchmark, what kind of numbers and what kind of milestones you will have to hit. So, lot of things in the business is not just only the direct relationship with capital. That, okay, if you have double the capital, you will be able to go double the. Sometimes it takes times to actually reach to the stage that, okay, will you be, the market would also learn from it. There would be some pace of word of mouth. So it takes all those steps, and all of them are not in the linear relationship with the capital. So sometimes financially it could be a wiser decision to take that money, but from a business point of view, business sense, you will have to be concerned that who is the right investors, what is the right amount, what is the right value, so that I can have a gradual growth there. So over aggression happens because of the excess capital that you raise. That is the result of the over. So I do not blame the founders all the time for all those failures. It's sometimes the blame to be given to the VCs also, to value some company too higher or to give excess capital, and that brings an unnecessary burden on the founder. That, okay, you have to grow at that pace, which is inorganic. So the blame is goes on both of them, investor as well as the founder. And but the founder should incorporate all those potential risks and all those cash flow risks. If they incorporate them, uh, by DNA, all the founders are optimistic. I can relate to myself. So you're super optimistic.
Yes.
This is a super optimistic all DNA. But I think uh, you have to incorporate possible failure scenarios, possible situation, and then incorporating that, you should know that, okay, this is the right stage, right place to go. And we do respect them when founders say that, okay, I don't want to go beyond that. So I think it's the founders who have to take a call without being influenced on what the market is thinking, what they will be able to do. But founder himself or herself knows them better. That, okay, what is this industry demand and what are they capable of doing? So that is a mix of it.
That's true. And since you're in the early stage startups, right, where money will really attract people, because then they start thinking that, okay, with the limited cash flow, I could do this. Now I have somebody who's going to give me, huge sum of money, and this is what I can do, and let me dilute my equity and get that, and let's see what happens. So what are the key things, especially for an early stage startup founder, he or she needs to keep in mind before agreeing to dilute for that kind of a money?
So I'm not sure if I got your question completely right, but I think dilution is fine. So one is that how much you dilute in one individual round, so that you have enough space for the future investors to come in. That is important. In some businesses, you would need initial capital, like if you for example, deep tech startups, they need a lot of capital before the product gets into the market. But once it gets into the market, the product would be very, very much better than the existing solution. So they will be able to charge premium. They will be highly profitable. They wouldn't need further capital. So it's okay to dilute at that stage. But you know that, okay, to reach to that commercial stage, how much capital you will need, how many rounds might be required, and then how much you can dilute in a single round. While for a different use case, let's say a D2C startup, your pace would come with time. So you would not want to dilute early. You would want to achieve some traction first, and then you raise more, and then some more traction. So that, because you will continuously need more capital as you will grow. So it's base. You have to understand your industry. You have to understand your business. That, okay, how much capital at what stage it would require. Then you would need dilution, and then the investor who is investing in you in early stages is taking much larger risk than the someone who will be coming later. So they would also want to gain some premium out of it. So the valuation and the amount of dilution has to be right, so that the scope is right, and a later stage investor would also see that, okay, have the earlier investors gained something or they are stuck in it. So all of that positive word of mouth around the company comes basis that. Second thing is that sometimes founders will raise a lot of angel capital or strategic capital very early on. That, okay, they will dilute 25-30%. And now if they grow very well, then next investor would be getting 10-15% for 5x higher the amount. Now they know that I will be sitting in the board with with my 5x higher the amount invested in the company, but still be lesser valued than the existing investor. So they would that also complicates the process of decision making from the VC, that how much say I would be having in the company compared to not the founder but other investors also. They would at least we want to be at par with the existing investors when a new set of investors coming in. So one must not dilute too much. Then also the kind of investors what you want to choose. You want investors who would be able to help you, but you do not want such strategic investors very early on who will like hijack the company, and then no other strategic acquirer would be coming in the company at a very later stage. So exit becomes difficult. If you get a strategic investor very early on, it becomes slightly difficult to acquire clients who might be competing with your investor. So
Mhm.
this is also important. So an investor could be strategic in nature, but maybe you can take an individual's check rather than an organization check. So that if you are selling a company, let's say if you're selling a product to automobile companies, now an automobile company becomes your investor. How comfortable their other automobile competitors would be to take your technology or product. So you have to understand that scenario. Maybe you can take a very small check, which is just financial check. But if you take a strategic check from them, they have 20% equity in your company or more than that, then it would become difficult for other competitors to take your technology. So these factors the founder should keep in mind when they're raising initial capital from the investors.
Mhm. That's really interesting, and I'm pretty sure because I made a note of it because I'm pretty sure I'm going to take a lot from this conversation. There's another thing that really wanted to ask you was, like when a founder comes to you for pitching their idea, or if they have already built something to showcase their prototype or anything like that. So, in your mind, what are the checklist which gives you the green flag that okay, this is the one I really would love to engage with and talk ahead and probably be a part of it?
I think the stage that we come and seed the seed, I think we would not be able to see a lot of traction. What we would like to see is that the team and the market. So first of all, the team, because if we see someone who has tried doing some startup earlier, failed or successful, that's a really green signal. And then the way they closed it, the way we sold it is also important as a kind of person you are. Second, is if they come from a sectoral experience. If you're creating something, do you have a relevant sectoral experience? That means you understand the nitty-gritties of the industry. You have deeper understanding of the problem that you're solving for. Or if you are building something deep tech, does your pedigree gives you that much technological advance other than that? So I think any of these is would be giving a green signal to us in terms of the team. Second, in terms of the market, that what they are trying to solve for. Uh, will this be a deep enough market, the large enough market? So if you get initial success, and that would give an indication that okay, this sector alone is this problem alone is very large, and the company can really become very large. And there is limited competition in this. So there are not too many large competitors who have 10x or 50x more capital than you. If there are 3 4 competitors who have almost similar capital, that's okay. But someone who has 50 times more capital than you would be very difficult to compete with them, whatever advantage you have. So I think the market size, the kind of competition the market has, along with the kind of team who can execute. So markets might change with pivots, but team will not be able to change. So team is the first priority. Then comes to the market. These are I think, the green signals about, and all of this indirectly results into that okay, founders understanding of the problem that they're solving for. Agar if they have a right understanding about that, they will be able to do the right pivots, they will be able to do right adjustments to the market. So all of that will happen, and we know that in that journey this will be something we will be facing. That's why the right understanding and why they're doing it is very important at that point.
Interesting. And do you have a soft corner for edtech? Because edtech has been something that you've been a part of, right? It's a domain that you really understand because you've been in that for 8 years and you're still doing it. So, do you have, or is there a kind of a bias that if any edtech company comes in, you're like, okay, you come in first, and let's talk about what you want to do?
Personally, I have a soft corner towards anything which is solving for children's need. It could be ed tech, gaming tech, edutainment, toys, all these category. I have personal bias, but it has to make financial sense also. So my personal bias might not affect the professional decision making, and that's why I think we are a good mix of partners also in warm up. I come from edtech background. My partner Rajan comes from agri-tech background. Yogesh comes from D2C and exports background. So I think that good mix keeps that balance of making a rational decision of investing. Everyone has that personal bias, and sometimes that bias goes against also. We are biased that what all will not work in this industry, and that
Right.
uses our capacity to take risk. It's not always in favor; it goes negative also, and where that is where the other partners come in picture. That okay to balance that decision making. So yeah, but I mean, of course, personal passion, and we are keen on looking at something in this category. But very few world-class products have come in edtech from India. Uh, there are lots of solutions, but very few would can be scaled globally. So someone when we find teams who are building products or solutions which have the benchmarks of global level, that would definitely generate a key take our interest.
Mm. And you rightly said you all come from a different, and it's a mix of different domains coming together, so you are making sure it's a balanced decision. So has there been any time any kind of ego clashes, maybe between you three partners, or even between you and the founder, if you're coming from the same domain, right? I mean, they might come and say, okay, you have built yours, now it is our time to build ours, and you're saying this is not going to work.
No,
Anything
no,
like that has ever happened in the journey?
not at all. I mean, we are not very critical in terms of okay, this will not work. We would know that okay, what doesn't work, but maybe you have to be extra precautious about that. And if the founder is confident, brings it, solves it, they are improving themselves. So of course, no clashes with the neither with the founder and within the team. I think we all respect the domain knowledge the other person is having. So if I'm looking at something agri-tech, I would not be having any ego problem. I would actually respect that. Okay, Rajan's knowledge would be much far better than me. The distribution knowledge would be better. What doesn't work, the financial knowledge would be much better in that domain. So I think that is the respect, and then we will look up to him that okay, that is your final call. While you're biased, while you may be biased, but you will give the best insights, and then we can take a concise call. So I think ego has no place in this industry. I think being a better human is the biggest challenge, and that is the biggest victory in this industry. The how small this industry is, I think ego will have no place in here.
That's really amazing to hear. I guess this was more of a Shark Tank based question, I would say, because you see a lot of drama happening with the kind of to and fro that happens. So how many startups so far Warm Up Ventures has invested in or mentored, and also what has been your hero so far when it comes to Warm Up? You say that yes, this is what we thought this idea or a company would do, and this is what they have achieved. So just share something like that with us.
So I think within the partners personal portfolio is about 100 odd companies, which is prior to the fund. So Yogesh, me, and Rajens, if you see the combined personal portfolio, there is a very large portfolio where we get learnings from and where we have seen success and failures. From the fund, we have done so far around 11 commitments. The money has been credited in about 7 companies. And since September 23, we have started investing. So almost deal per month is something that we are doing currently. So in terms of outliers, there are, I think, well, fortunately, good number of our deals are doing well. So one of the company that we invested is in the QSR segment of bubble tea, company called Buba Bhai. When we committed, they were at about 30 lakhs MRR. They have almost increased that to 10 times on a monthly level. So really good founders, come very passionate about the food category and really depth understanding of real estate and QSR. Another company is into marketing tech. They started monetizing. Second time founder again in the marketing industry, sold his previous company to Shiprocket. The founder of Nitro. So they are working. They are creating something game changing technology in how the brands market on their own website. So we'll be directly competing with the marketing spends of Meta and Google, and helping the brands to actually improvise or actually optimize their marketing spends that they're doing on their own Shopify or their own websites. So couple of these and few other companies in the enterprise IoT domain doing really, really well. And I think we will see their up rounds towards the end of this quarter, towards the end of this calendar year. So I think 4 of our companies might be raising their next round. So in this year, so doing well, and I think it's you can't really predict it. From the fund. We have almost completed 1 year from the idea, 9 to 10 months from the first investment date. Uh, you would see some companies just going like this, some companies will fall a little bit this, and then they will take their curve. So that hockey stick will also come for them. But I think have been fortunate with the kind of network we have with the other founders, operators, with other VCs who are kind to share whatever they're coming across, and we are getting good deals there.
That's really amazing. And I think, like what we said in the beginning itself, what sets Warm Up Ventures apart is the fact that it has been created by founders for the founders. So this has really, given that kind of a, because they know that this is the commitment level they are going to get from you as well once you engage with them, because you understand the process and you're there with them emotionally, mentally, any kind of support that they need during the journey, because it's not just about working, right? There's a lot of mental strength also you need to reach and scale that part. So I'm really sure that we are going to hear a lot coming from Warm Up Ventures, and I wish you all the best. And just the last question, in case any startup wants to, get in touch with you. So what is the best way to get in touch with Warm Up Ventures?
Yeah, so just to add one more line, by the founders, for the founders, and also backed by founders. So
Yes.
most of our investors are also.
I'm sorry to have missed that part.
So I think that combined effect is like such a wide experience of founders who have backed us. So they are also strategically able to help our portfolio companies. But for founders to reach us, very simple. They can go to our website, warmerventures.com. There's a form they can fill it. We look at each company. Alternatively, they can also email us to pitch@warmerventures.com. They can find this email ID on our LinkedIn page as well. If they are slightly before raising capital, they want to just discuss the idea, they can also reach us on LinkedIn about sharing that. So all of the channels are open. They will go on the same place. We will also tell them to go to the same place. So whichever way they are comfortable with, they can definitely share.
Thank you, Sharad. Thank you so much for sharing your insights with us and, giving us, I think I've got a fair amount of idea what Warm Up Ventures is going to come up, and probably, in the future, we're going to hear a lot from you and big companies being backed by Warm Up Ventures to reach that particular, scale. So thank you so much, Sharad.